you're in the midst of a very complicated, delicate two-phase maneuver. When first you were flooding the world with money in order to get the economy going, and then you have to take that money out of circulation and tighten. And similarly with the budget, in a recession, when you've got idle resources, you want to put those resources to work. And the debt is defined as in relation to the GNP, the economic activity. So if you have a growing economy, you can actually tolerate a higher level of debt. And if you have too much debt, and you have a recession, then actually a falling economy, you get into what is called a debt trap. So this is the big issue. And it is, I'm afraid, overshadowed by political considerations. In other words, I think you have a financial crisis in Europe, but and there's a question of Spain and Portugal and Ireland and so on. But that is a different problem, because those countries are part of the Euro bloc, and they are not in a position to issue their own currency. We can issue our own currency, and in fact the dollar is quite strong. So it's really a matter of political judgment, and that's where you have very different opinions, and there is a very strong push to tighten the budget as a way of reducing government spending. So it's resistance to any kind of tax increase and tightening particularly the budgets of the states, because they cannot issue their own currency. So they are in a similar situation to Spain and Portugal. And there is, I think, a danger that by pushing this too far, you could actually abort the very fragile economic recovery that we are currently enjoying, and push the economy once again into a slowdown or a recession. And I rather fear that these political forces are going to push you there.
So the threats that we hear about the U.S. government debt and the fiscal position overblown?
In my opinion, the country could actually absorb some more debt in order to get the economy going. But it's a question of how do you use that money. If you just use it to reinforce consumption, then you don't really get any benefit from it. But if you were to use it for building infrastructure or to improve productivity, then I think it would be a very wise thing to do.
That's on the fiscal side. What about on the monetary side? The Federal Reserve not tightening, the European Central Bank is tightening. Who's right, or are they both right?
Well, no, I think there are two very, very different perspectives, different directives that govern the behavior of the European Central Bank and the U.S. Federal Reserve. Because in the case of Europe, it's a one-sided directive. Your only job is to prevent inflation. And in the case of the U.S., it's a more balanced, maintain employment and price stability.
You mentioned the U.S. dollar before. Is it still one of the safest assets?
Well, it is, let's say, considered to be riskless, but it's really a question of the degree that you may have inflation in the future. Because one of the ways in which you can reduce the burden of debt is by having some degree of inflation. And actually, here it's considered desirable to have 2% inflation. But that's very hard to hit. Now you have some inflationary pressures in the world. I don't think that there are any great inflationary pressures in the United States.
The delegates who came here in 1944 gave the U.S. and the dollar the prime place in the world. Does the world need a leader like that now? And if so, which economy? Is it still the United States?
Well, there's a big question whether the U.S. Dollar should be the main reserve currency. And in fact, it no longer is, because it maybe accounts for 2/3 of the monetary reserves. But there's, the euro is an alternative. And there's a lot of diversification into other currencies and even more into commodities, not only gold, but actually oil. Oil is now an asset class for investors, and that has put some upward pressure on the commodities.
Do you think in terms of the euro, the sovereign debt crisis has diminished the chances of the euro's becoming a reserve currency?
Well, the euro is under some cloud. But that's exactly because there are some inflationary pressures from the price of commodities, particularly now oil, and also food prices have risen. And that is what has induced the ECB to raise interest rates at a time which is, in my opinion, quite inappropriate.
Too soon?
It is well, what do you mean?
Too soon that they raised interest rates?
It is not appropriate in the current circumstances when you've got a number of countries that are suffering from too much debt and high interest rates that they have to pay.
Well, is that a policy error based just in this time, or is that a symbol of the failure of the institutions that this conference here is sort of meant to address?
Yeah. No, this is actually some really quite profound differences about how to manage monetary policy. And in Europe, which is very much under the influence of German history, because Germany has suffered hyperinflation. So that was the traumatic experience for Germans. And for other countries, unemployment is the depression, is the traumatic experience.
What about China? How much of a concern is the inflation there to you?
That is a serious concern because China has really stimulated its economy full force, very successfully, and now it's trying to rein in the rate of growth and is exercising very strong constraints on the banking system. But because of that constraint and because of the great demand for money, a shadow banking system has arisen and is growing very rapidly. So while the big banks that are under direct central control are in fact refusing to lend, there's this shadow banking system which is growing out of control. And that's now, there is a real danger there of wage price inflation, because prices have gone up, and particularly real estate prices have gone up because there was a real estate boom, and therefore wage demands have risen, and you now have 20-30% wage increases. So the Chinese government, I think, made a mistake not allowing its currency to appreciate, which would have controlled the price inflation. And instead of that, you now have this wage pressure, which is a little bit out of their control.
We're here to talk about new economic thinking to deal with the problems that arose by the outdated financial system. The Chinese current economic approach has only been in place for a couple of decades. Have they done something right that others should emulate over that time?
They have done, they were the major beneficiaries of globalization, and they were, of course, the big winners in the financial crash, because their economies was largely isolated because they have capital controls on their currency. They have a two-tier currency system, whereas the rest of the world, following the Washington Consensus, allows free movement for capital, and you had runaway expansion of credit and leverage, which then resulted in the financial crash, and China was largely immune. So they benefited tremendously. And their system, which is really stands in contrast to the international system. Let's say there's international capitalism with free movement of capital, and then there is what I call state capitalism, where the state basically controls the economy. And that system actually has performed significantly better than the international system. And so now it's beginning to be imitated by others. But I think it's a tremendous mistake, because that was just one particular set of circumstances when it worked better. And they had an advantage because they were the only ones that were controlling capital flows. So as a result, they not only controlled their own currency, they effectively were controlling the world currency system. So now other countries defensively are beginning to follow them. For instance, Brazil just doubled the surcharge on capital inflows. And that is not good for Brazil, and it's not good for the global economy, because it really threatens the global movement of goods and also of capital.
We have to wrap it up soon, but of all the risk that you look at right now facing the global economy and the global markets, inflation in emerging markets, the disaster that we just saw in Japan, China, U.S. unemployment, what is it that keeps you up at night?
Well, all of the above. I find the current situation much more baffling than the boom bust and the financial crisis itself, because there actually my theory, which is an alternative to the one that's generally accepted, actually gave me very, very clear guidance. But now you are in what I call far from equilibrium territory, with lots of imbalances. And how they are going to be resolved are very much more political than purely economic. So you have currently what I call a reflexive interaction between imperfect markets and imperfect regulators. And the outcome of all these various imbalances, and there are 7 or 8 of them in the world, are very, very difficult to predict.